Today we're going to talk about pipelines. A couple weeks ago, I had Jason Hall on the show, and we talked about T. Boone Pickens' legacy, but we also talked a little bit about the tax that had happened on the Saudi Arabian oil facilities. We got a question back from one of our listeners, Leland Payne. He said, I appreciated your commentary about the attack on the Saudi Arabian oil facilities and the market action for crude oil as a result. It was mentioned that there is a takeaway problem from the Permian Basin. It is my understanding that Kinder Morgan and Enterprise Products Partners are constructing significant pipeline capacity to take away oil and natural gas to the Texas Gulf Coast and to Mexico. Would appreciate hearing a podcast on these two midstream companies. Matt, so first off, on the pipeline takeaway constraints in the Permian, can you just, for folks that are unfamiliar with what's going on here, what's the high-level story there?
Yeah, so the Permian Basin just has like a ton of oil and gas. And so oil companies have just been drilling and drilling and drilling. And they've drilled so much of it that it's overwhelmed the infrastructure that was there. And so it's kind of slowed down the progress out there. And it's just created this huge bottleneck of oil and storage. And then there's too much gas that they can't use. So they need infrastructure. And that includes pipelines, among a whole bunch of other type of things like processing plants and that type of stuff.
Yeah, exactly. I mean, production has just exploded so much in the past decade or so in these big shale plays, particularly the Permian. I've cited these numbers in the past, but between 2008 and today, the United States accounted for 73% of the increase in oil production worldwide. If you look at natural gas, the Permian Basin accounts for 10% of America's total natural gas volume and expects to double that output by 2025. So just when it comes to, pulling hydrocarbons out of the ground, that's an incredible growth in production. And you have to take this to market. And as you mentioned, there's led to, huge oversupplies, which has depressed prices in the region. It's also led to this trend of flaring that's been in the news a lot over time. Matt, can you talk a little bit about that and what kind of the controversy has been there?
Yeah, so flaring is just a way of getting rid of gas that they don't have pipelines for. And unlike oil, they can truck that to different storage places, but natural gas, it has to flow through a pipeline or be liquefied. So their options are to either re-inject it back in the ground, which costs money, or to flare it off, which is to burn it off. And so they've been doing that, and they burned off so much gas at the end of last year. It was stunning. They could power every home in Texas with the amount of gas they're flaring off. And it's just because it was cheaper to just burn it than use it. But these pipelines, they're going to help solve this problem. And, they'll be able to monetize this gas.
Exactly. So whenever pipelines come online, the cost to get that to market decreases, and so it can make economic sense to start delivering this gas to market, which is obviously great. We don't want to, this is a clean burning fuel that we would like to see put to good use. Before we dive into Kinder Morgan and Enterprise Products Partners, I want to talk a little bit about investing in pipelines from a high level. So when you first look at a pipeline or a midstream company, what are the first things you pay attention to from a financial metrics point of view, Matt?
Yeah, so there's three things that I look for in a pipeline company. The stability of their cash flow. So one of the big draws of pipelines is that they pay these big dividends, and that's because they generate very steady cash flow. A lot of times it's based on these fee-based contracts that they sign with producers. So, an ExxonMobil drills wells in the Permian Basin, they need to get their oil to the Gulf Coast, and so they'll sign a contract, to ship, let's say, 100,000 barrels a day on a pipeline. And so these pipeline companies just collect that basically like a toll booth fee as this oil goes through. So I like for stability of cash flow, and the number that kind of sets off for me is 85% or more. That just gives them, just this really predictable cash flow. The second one is the payout ratio. So we mentioned that the dividends are the big thing with these pipeline companies. So I want to make sure that they can sustain that payout. So I'm looking for a payout ratio of less than 80%, or another way that they kind of like a metric they use is a distribution coverage ratio. So the equivalent of that's 1.2% or 1.2 times, sorry. And then a healthy balance sheet, which is an investment grade balance sheet in my book. And that just means that bond rating companies take a look at their books and say, this company is worthy of investors' trust. And the typical number that they look at is 4.0 times debt to EBITDA or less, which is basically companies generate enough cash flow per year that within 4 years they could pay off their debt. So those are the three metrics that I look for.
Yeah. So, and What's attractive particularly about these midstream companies, I talked about earlier about this huge increase in production of oil and natural gas. That makes it hard for the folks that are pulling this stuff out of the ground to make money because the price is pushed down. However, the folks that are distributing this product to market, there is more oil and natural gas flowing through the pipes, and on these fee-based contracts, they're able to make predictable, increased returns on that. One question I have when I look at pipeline companies, it's hard to differentiate one project from another when it comes to what kind of value they're going to return to the firm, and I guess how to differentiate one pipeline company from another. So when you look at projects that these companies are investing in, how do you differentiate high-quality projects from low-quality projects when it comes to investing in these companies?
Yeah, so as I mentioned earlier, it's the stability of the cash flow. So there's different types of projects that kind of have different types of cash flow backing to them. So a gathering pipeline. So an oil company drills wells out in, let's say, Texas, and then they put these pipelines right close to it to kind of gather all the oil and bring it to a central processing plant. These have a lot more variability to them because if the oil production drops from those wells, then the revenue will drop. Same thing with natural gas processing plants. Sometimes they're not even volume based. It'll be like the money that they can make on the difference between what they buy natural gas and then what they sell the end product from. So I don't like companies that are involved in those they're called gathering and processing. I like pipeline companies that do the long haul pipelines. So, when you're talking about these projects that a Kinder Morgan are building, they're these long pipelines. They're 100% contracted, and so they know exactly what they're going to get every quarter, every year. They're going to get the same amount of money. So I like that stability when I'm looking for a pipeline or working for a midstream company.
Sure. And on the back half of the show, we're going to talk specifically about Kinder Morgan Enterprise Product Partners. But is there another midstream company that comes to mind that kind of checks off all those boxes that you like to see that maybe investors should pay attention to?
Yeah, so one of the favorites that I have, kind of specifically oil in the Permian Basin, is Plains All American Pipeline. They're a master limited partnership, but they also have a corporate option that investors can do. It's called Plains GP Holdings. So there's two different options for investors. It pays a great dividend. It's 7.5% right now. But again, I'm looking for those big three. So in this case, it's 85% fee-based cash flow backed by those long-term pipelines. And then their dividend payout ratio is actually 50% right now, which is exceptional. So that means they're only paying out half what comes in for the dividend, and the other half they can use to reinvest in new pipelines. And then the third thing that they excel at is their balance sheet. It's investment grade. It has a 3.0 leverage ratio, which is obviously better than 4.0. So they've got a great balance sheet, great payout ratio, steady cash flow, and that gives them all this financial flexibility to invest in new projects. I think they're up to like 7 pipelines that they're working on right now. The most exciting one is this Wink to Webster pipeline. It's an oil pipeline project with ExxonMobil that will start in 2021. It's going to ship over 1 million barrels per day from the Permian to the Gulf Coast. It'll help Exxon putting some oil in some of the refineries, and then they'll export it. So great project, and it'll help Plains grow its dividend. They're looking at least 5% per year for the next several years, and it's super safe, like I said, with those great metrics. So I think it's a really interesting company for investors to take a look at.
Yeah, it's one to check out. It's the tickers on those is PAA and PAGP.